So weekly demand surges 20% higher after interest rates dropped to the lowest since last year. Well, last year was only a couple months ago, so like that's not really it's not really like earth-shattering. But obviously, mortgage rates went down, and the mortgage application volume like spiked up because of that. So it tells me two things right out the gate. Number one, people are watching really closely, because if you see a week-over-week change of a 20% increase of mortgage activity, that means just kind of like one eye you're sleeping, the other eye is open, right? As we say. And the other one is clearly there's demand at a moment's notice.
Absolutely. I mean, Andy, it's all a fear of missing out. You know, like, what am I going to get? I get the opportunity. I might as well strike right now. You know, I'll figure it out. I think that whole, cliche where people are saying, don't marry the rate, marry the home is coming into effect. You know what I mean? Now, because that 0.25% you're talking about here, we're in San Diego, right? The medium sales price is like $900 some $1,000. So when you're talking about a 0.25% difference, that's a huge difference in payment. That's like $200-300 a month. That takes your debt to income ratio to another level where, okay, now I can actually afford a little more.
Yeah.
You know,
and I think also coupled with the changing insurance premiums, people might be looking for savings on that part of their life.
Yeah.
And I know that may be a little bit of a stretch, or might be a very small percentage of people, but hang with me here for a second. You know, we were talking last week about how people's behaviors are actually changing due to insurance. Yeah. So if people's mind frame is getting on this whole insurance is going to cost me more, or I don't know what I'm going to do by my insurance because of the insurance carrier stuff, if you got to save $200-400 on one side of your housing payment because the other side's going to have that increase, I don't know how much is being driven by that, but I'm saying that could be a contributor to this whole one eye closed, one eye open on the rates kind of situation.
Yeah, of course. Yeah. Because it kind of balances it out, right?
Well, in addition to the fact that, you know, if people are just looking to save because they have other expenses or their other spending habits are going a little bit out of control, there might be some of that. And let's be honest, if you bought a house in 2023 or 2024, your rates were already higher than they were in 22 and 21 and 20. So you don't have the lock-in effect, and anywhere you can save, you might be looking to, especially if it is tight.
Yeah.
Also, I mean, I feel the rates also bring a big more pressures because they get approved on their gross income, but they have to pay the mortgage payment on their net income. So that difference in the rate, whether it be an eighth, a quarter, or whatever it might be, that can make them or break them, because in their budget, they got approved for that amount, but really what they take home after taxes might not be enough to cover that payment in a comfortable way where it still allows them to do what they want to do. So therefore, they have to compensate, bring the purchase price lower, or figure out another way to get creative.
Yeah, no, absolutely. I like how it says a sharp drop in mortgage interest rates finally lit a fire under loan demand.
Yeah,
like it does. It makes a difference, But we see all the indicators, everything that's going on. We still have unemployment at its lowest, 4.1%. Is the last time that I saw that it was that it mentioned that. So 4.1%. We have these tariffs coming in for Canada that got implemented with Mexico, Canada. We have these tariffs with China. So we all could have sworn inflation is going to get higher. So why is the rates, how is it that they've come down? So it's hard to understand the reasoning now. Are we really saying that Trump, because I know he said he was going to told the Fed, Uncle Powell, reduce the rates.
Yeah, it's like
that's what's happening.
I call that podium pressure, right?
Yeah. Does he have direct influence like that?
Everybody knows he does not.
But isn't it crazy?
I feel like
it's the market's reaction to those other things that are happening. So it's the market's reaction to those things. Sorry if I'm cutting you off there. It's the market's reaction to those things. So as there's a saying, like as the bond market goes, so does the global politics, and there's a lot behind that. Yeah. And mortgage-backed securities broadly follow the 10-year yield bond market. And so if that thing's going down and going lower, well, so are mortgage rates. It's going to follow it on the way down.
That's what we're seeing.
And if they go up, it's going to follow it on the way back up. Yeah. It's like a trail. It's like a coattail.
I mean, and you follow that very well, Andy.
Well, it's a dork.
I'm a big nerd. But you've been seeing that drop.
Yeah. Well, the thing about it is it was almost telegraphed on the chart, because ending January coming into February, like, it got rejected up at this high, so it's going to absolutely have to go low just from a trading perspective, the bond pressure, and then all the global political stuff, tariffs, the war stuff in Ukraine, the Israel-Gaza stuff, just the wild things that are happening with Doge, like all that kind of like dogpiled, and the market was all and like really started tanking in February. It was crazy.
Yeah, I mean, it's good to see, and I think there's nothing wrong with even our rates just being in the sixes.
Well, I
We
think
don't
they're
have to go,
normalizing
like-
that for people.
Yeah, and it should be where people could adjust because the 7s, it was crickets.
Well, yeah, that's going to cause unintended harm to the market, just as elevated prices do from an inflationary
go.
perspective too.
Unintended harm.
Unintended harm, and so, but at the same time, what I think you're going to see what I think we're going to have to see, whether or not it happens, is whether it brings sellers off the sidelines. I think sellers will still have a little bit of hesitation, even though mortgage rates are down, because if they did buy in 2020, 21, or 22, or they already owned prior to that and refinance in those years.
Yeah.
They got those handcuffs, man. They got a 2.75, 3%, 3.25,
Even a 4%.
Like even 4. I know. Even 4. If I call someone right now, it's like, hey, I'll get you a 4.9. They'd be like at the door. They'd
Where?
be lined up for
Where do I
miles,
sign?
right?
Yeah. Oh,
I
yeah.
know.
100%.
Right.
Yeah, no
To,
worries.
let alone 3.5,
No.
3, 2.5, whatever. So
Even a 5 will start, bringing people back in a lot
right.
more
So
than we see. But
so I'm just saying, I think that's part of what we have to just watch and see what happens, regardless of all the international, global political kind of stuff, even a lot of our national politics. Like, we just have to see what the behavior is going to be tilted and shifted with the market going that direction.
No, I like that. I like that you broke that down.
what I've seen is it comes in waves. Like there's weeks where the pricing of rates are down, and then inflation data comes up, they come right back up. But I feel that's why you have to be even more proactive during these times, because you have to strike when the time is down, when the waves are low, because they'll come right back up, and then you have to wait for it to recalibrate, go right back down. But I think there's going to be pockets, waves of high rates, low rates. But if you're not in the market consistently, if you're not actively on the market, then you're going to miss out on those opportunities, and you're always going to be playing catch up until you solidify yourself into an approval and start moving forward.
So I'm going to bring back something I thought of when I was preparing for today's show, reading this. Do you guys remember in the spring of 2020 when COVID first happened, and it was like, everybody go home, 2 weeks to slow the spread, flatten the curve, all this stuff. And you had a conversation with Ron that you shared with us, and Ron was like cool as a cucumber, like, hey, guys, it's going to be okay.
Yeah.
They're going to figure something out, and like, this is actually going to work out for our favor. Just hold tight. And he sent like this whole company-wide message, right? Yeah. I remember this. And the number here on this report is similar to what happened back then, and I'm going to go to it right now, which is 83%. There was 83% higher than the same week 1 year ago.
Dang.
So put your mind in spring of 2020 when there was like this absolute screeching halt to the market, like no one did anything.
Yeah.
1 year later, what happened by spring of 2021? Everybody's refinancing. Everybody's trying to move. Everyone's trying to buy a house. Everyone's qualifying, and rates are super low.
Yeah.
And you saw this same type of like statistical anomaly of this massive increase of mortgage activity because of that. Turns out Ron happened to be right.
Yeah.
But that's the last time, or the most recent time, when we saw a statistical anomaly that big.
Yeah. Where are you, Ron?
Yeah. Well, and it's in times like that, when you're really close to like, oh, there's this problem, and it's just being like forced and fed to you constantly everywhere you look and everywhere you talk. You kind of go, okay, well, what's that mean for us? Like, how do we localize that as a business and as a person who's inside the company and inside this industry? And you're like, well, I have no idea what's going to happen. And then he's been there for decades, and he's like, no, it's going to be okay. We're going to figure it out. Like, part of me goes, well, yeah, you're the boss. You're supposed to say some
You're
of that
supposed
stuff.
to that, yeah.
You're the
Keep
the
us at
owner.
ease.
Everything's going to be okay. Don't worry.
But there's also that like seeing through the thing that I'm like, I think we really benefited from that a lot during that time. Yeah.
It was a crazy time.
Yeah.
I do like here, what it states here. Mortgage rates were clearly the culprit. The average contract interest rate in the 30-year fixed rate mortgage with conforming loan balance. I like how they use the conforming, obviously. 806, 500 or less decreased to 7.3 from the 6.8,
6.73.
6.73, yeah. 6.73 to the 6.88. I mean, that's not a 0.25%. That's just a little bit. That's
Smidge.
enough for people just to have 20% of people just to start getting active. Like, that's crazy.
Yeah. And so on our side of things, like that is more representative of what happened on the actual rate side. But on the pricing side, where it comes down to buying your rate down or how much credit could go towards a deal, there was a much bigger change on that end of the business than there was on the front side of the actual posted rate.
Yeah.
So I think there's more of this to come is my kind of like end all be all for this. I still think there's going to be more mortgage demand because now they've seen it happen. There's going to be this expectation, when that comes back, like a merry-go-round, when that comes back around, I want to be ready. Yeah. Oh, well, if that's going to happen again by the spring and I want to buy, or the summer, I want to buy. I think that's going to shift some behavior into that direction. I think we're going to continue seeing an increase in mortgage applications coming into the spring.
Yeah. You don't have to buy now, but you do have to be ready.
Dude, yeah. Even if you're not buying now, get ready now.
Yeah.
Yeah.
You know, when I saw that, it just prompted me to go see, you know, I saw the 806 and my key word was, the keyword was less than that 806. Well, in San Diego, when your medium sales price is $949,000 according to Redfin, that equals to about $704 a square foot.
Yeah.
That's pretty crazy. Because that rate, remember, people, that's for loan amounts at an 806 or less. When you're in the 900, you're talking about a 7.25%, 7.5% rate. That makes a huge difference because your loan amount's larger, and therefore now your payments just